we'll get started. So thanks again for giving me the opportunity to talk tonight. This is a little bit different focus than what we've done in the past. So I'm going to try to build in a bit about sort of the outlook of where things are going and build in some examples in terms of looking at options and considerations for selling or retaining calves. One of the things I think that's important to sort of set the tone for off the bat is, in many cases when producers are marketing calves, you're marketing them in a more defined sort of time frame than you are if you're somebody who's in a feedlot circumstance where you're buying, almost weekly or monthly, that kind of thing. So there is some nuance, I think, and differences in how you go about the analysis and thinking about that as a producer, and it all does, again, come down to your individual circumstance, knowing your cost of production, understanding your capacity, your labor constraints, your feed capacity, that kind of thing. It all sort of comes into that. So again, I'm going to sort of layer in where things are going, and in particular focus on the feeding side of things as far as costs and the demand from a cattle perspective and what that might mean from a price point of view. Again, I think, with the focus here being, the idea of calves either being sold or retained into a backgrounding circumstance. And so that is a fair bit different, again, than a normal feedlot circumstance, which we tend to do a bit more focus on. And so I'll make sure I build that in. In terms of the U.S. crop situation, again, from a feeding perspective, it's been a pretty strong year from a yield perspective in terms of corn. The U.S. is looking at a record crop. They're in about the third to fourth year of prices falling off of the 2022 crop year highs. I think from a feeding perspective, the key things to consider is basically that prices have fallen to basically a plateau. It's unlikely that in the next year, again, the crop year is just sort of started for the most part as far as the sale and marketing of the crop that was harvested this past fall. Again, that's the 25-26 crop year, both in the US and Canada. And so I think for the most part, even because of that large volume of corn, we're kind of in a bit of a holding pattern as far as pricing is concerned. As far as your feed costs go, I think you would want to expect corn and soybeans to be relatively flat. There's going to be opportunities from a hedging point of view if that's something that you do. A lot of backgrounders don't do that to the same degree as feedlots do, but it's certainly something to think about. But the other thing to consider, again, is that the U.S. is in about the third year of costs being at or above their market price. In other words, in a negative margin circumstance. And so that's going to continue to pressure acres over the next couple of years. And you can layer in all the other trade stuff too a bit, but the reality is that their supply is likely to be somewhat constrained because producers in the U.S. are likely going to have to make some adjustments to address that. In terms of looking through the winter and thinking about how that affects corn, the value of corn over the spring and into the planting season, as well as what it might look like in terms of livestock inventories. You've got reasonable amounts of drought is how I would describe it for your corn, soybeans, and winter wheat areas. If you go back to 2012, for example, that corn and soybean number at the top, 30% would have been 45 or 50%. That set us into a pretty major trend as far as drought goes, et cetera, through the U.S. And that played out pretty significantly in terms of prices. But that's not an unreasonable number for this time of year at 30%. Winter wheat is largely in the plains, not really affecting us from a feeding perspective too much. On the cattle and hay sides, with about 25%, that's a pretty low drought percentage for this time of year in recent years for those areas of the U.S. Last year was about 40%. And so again, what that does is basically mean that maybe, feed prices from a hay perspective are a little stronger with not as much drought, or a little weaker, sorry, with not as much drought. And on the cattle side, likely representing that less likelihood of a large number of animals coming into the feeding system or the slaughter system throughout basically the late spring when grass inventories in the southern U.S. states might start to run out. And so what that basically then amounts to is a reduced likelihood that we would see some kind of supply push in the U.S. on the cattle side that would have an impact on pushing prices down too much because of that additional supply. The U.S. cow herd, like the Canadian herd, we'll go over it, is really in its sort of fifth year of contraction. This is a long-term decline And so again, the big thing here from a feeding perspective is a recognition that there's just not enough cattle around. With all the stuff going on with screwworm, with Mexico, with tariffs in the U.S. and in and off tariffs with respect to beef coming into the U.S., the reality continues to be that there really isn't enough cattle. Any rebuild in the United States or Canada is relatively muted, and we'll talk a little bit about that. And so again, what that continues to suggest is that the number of cattle around to serve that demand growth or that strong demand is relatively low, and that in turn is going to continue to pressure prices. Again, on a day-to-day basis, that may vary. News in the market, et cetera, can drive things, but for the most part, that market fundamental is really not changing. Again, in terms of meat production, again, the U.S. is again kind of a tale of two tapes with respect to meat production. Pork and chicken have grown significantly in the U.S. Those are your two contained industries. So their demand for corn in particular is somewhat relatively fixed. It's not it's not tied to a longer gestation period, and it's growing because demand for those products is growing pretty significantly, both domestically and internationally, pork in particular. On the beef side of things, we haven't really seen much growth in the last 25 years as far as the overall beef production in the U.S. is concerned. And they're expecting the next couple of years to be down 4 to 5%. So again, recognizing that the demand isn't changing necessarily. In fact, it's probably growing, and production is relatively flat, if not declining. And so again, all of the signs would point to sort of continued supply challenges as far as meat production, beef production in the U.S., and then that sort of translates further into the Canadian side of things. The U.S. cattle market outlook, is suggesting that for 2025, the fed cattle prices will have risen about 22% when all things are said and done. That's coming off a 7% increase in 2004. And then the math would suggest that 2026 is likely going up another 9%. So continued pressure there. On the feeder cattle side, basically a 15% increase last year, another 29% this year when all is said and done, and then another 12% next year. So again, continued pressure on the upside. And that's a tricky one, and I'll come back to that with respect to the backgrounding industry and this idea of retaining calves and where that sort of plays out for your individual decisions. In terms of the Canadian market, we have sort of continued strength in overall meat demand. Again, lean protein is growing pretty significantly on a per capita basis. So that's in aggregate. On a per capita basis, chicken is the only meat that's seeing sustained year-over-year increases. But again, recognizing that with the population, even though our population is growing as fast as it was, it's still growing nonetheless, and total demand has increased. If you look at the data on per capita beef demand for 2024, my math, because StatsCan only releases that data now every other year. So for 2024 was one of those out years. My math would suggest about a 4% increase in per capita demand. And this year so far, it's relatively flat. Why that's important, though, is that basically, again, in the relative sense of where meat demand is changing, beef continues to be relatively strong despite some of the changes in prices, and largely because beef has a lot more options as far as cuts, et cetera, than pork or chicken in particular. And so that's, I think, been a long time strength of the beef industry as far as consumer demand goes, and it's continuing to hold true. As all of you know, basically for most of our commodities, and beef's not any different, we import a pretty significant amount of our overall demand. At the Canadian level, it's about 21% of our demand overall. If you look at the Ontario numbers, again, it's not quite as easy to understand or calculate, but my math would suggest about a 35% import use as far as demand goes. And year to date, our imports are up about 14%. So again, that's a function of a few different things, right? Reduced volumes of cattle in our market, relatively strong demand, some competition. It's not uncommon now. You go into grocery stores in Ontario to see Australian beef. That isn't something that we always saw in the past. And so it goes to this idea of consumers want the product. Generally speaking, if they can get Ontario, they'll take that, but it's not always available, especially in the major retailers who, as many of you know, will have kind of a different wholesale model than what some of the smaller groups do. So that plays out from the import side of it. If you look at kind of where the market has went, and again, we still, I do anyways, try to look at a reference point being the start of COVID. And there are other reference points oftentimes in the beef industry. We'll go back to BSE as another one. If you look at over basically this last 5-year period, roughly, we've seen fed cattle prices rise about 117%. That's based on the most recent data. The most significant thing about this graph is sort of thinking about how the price of markets flow through. And this, again, I think is something for you as people considering backgrounding to think about. On the processor side of things, wholesale prices have risen about 92%, and on the retail price side of things, about 54%. Now, again, what this is suggesting is that normally we think about, if prices are rising significantly, retail, the general view in the farm community is that that doesn't always pass back through to the farmer to the same degree, or the farmer's share of the food dollar, as it's often referred to, is relatively low. What this does, though, indicate is that beef, because it's a pretty direct substitute to pork and chicken in particular, despite the big increases in retail prices, I think you could argue that maybe retailers have not been able to fully pass on some of those cost increases because they've had to make adjustments in some other sectors in terms of substitute prices that maybe haven't been quite as strong. And I'll talk to that on the next slide. And so this is a ratio of the retail price of basically the three main products. So the middle blue line is the ratio of the price of beef to chicken. And as you can see, it's normally in the neighborhood of about 2 to 1. So again, the price of beef is about 2 times on a kilogram or per unit basis that of chicken. Now, again, there are arguments to be made about, is a kilogram of chicken equivalent to a kilogram of beef, but we'll assume that away for a minute. And what we've seen in the last year and a half is that ratio getting up to 2.5 and over almost 3 at a couple points. And in some individual products, if you were to break that out, that's certainly been the case on individual cuts. That competitiveness continues to sort of decline a little bit based on the most recent data. If you look at the price of beef to pork, a little bit similar. It follows the chicken one quite closely, but generally speaking, fairly close. And pork has increased a little bit recently, and so beef has improved just a little bit in that regard. And then the bottom line is the ratio of chicken to pork. Now, again, interestingly enough, pork tends to be probably the best value from a price perspective, but not as many consumers want pork. It's not something that people universally understand how to cook. It's quite different. That's long been, I think, a challenge with the pork industry, and I think there's maybe a little bit of similarities with turkey as well. In terms of our fed cattle numbers, so one of the things that's tricky for those of you who've heard me do these presentations before is that we really don't have definitive cattle on feed numbers in Canada like we do in the US. We try to come up with them. Canfax does a survey of a few of the bigger feedlots in Alberta in particular, and does some estimates, but it isn't quite the same as what it is in the US. And in particular, we have a lot of people background in cattle, obviously, in this province. The Mennonite community has taken on a pretty big role in that. And so our ability to really understand those feed numbers and know, how many cattle are moving through the system to becoming or moving into the feedlot is a bit challenged. In turn, we also, because we don't have enough cattle in Ontario, despite our large population and strong demand, as many of you will know, and some of you probably do, we're bringing in a pretty considerable number of cattle from Western Canada. Some of them are calves, and some of them are, 1,000 or 9-weight cattle. It depends a little bit on the producer, etc. But that's in the neighborhood of a 40 to upwards of 44% based on my math this year. That's pretty significant, and that's in the hands of a relatively small number of producers. Really, it's something that is a little bit more variable. It's a function of a number of things, but it's also very time specific. It tends to happen in the spring or in the fall. It's not happening all the time. So again, it kind of comes back to this idea that I mentioned at the start, that there's some differences in how you would market cattle based on time of year and the process. We're also moving more cattle to the US. It's up about 44% this year, and so that's pretty significant. And historically, one of the ways that we've filled that gap in Ontario is that we've been bringing cull cows in from Quebec, largely into Cargill and largely on a kill day a week. Those numbers are down quite a bit. You're not doesn't it would be maybe half a kill day or roughly half a kill day from what the math that I would suggest. But that's also again an indication of that just there's not as many cattle around all across Canada, which means it's harder for packers to get those cattle from anywhere to sort of fill those numbers. And that reflects in the average slaughter numbers for the province. Again, it's always a unique one because we have Cargill, which processes the vast majority of them. We got St. Helens, which is not insignificant, but is not nearly the numbers. And then you have provincial plants, and the provincial plant model is largely a service model as opposed to a purchasing model like the federal plants. And so, our numbers for 2024 were about 9,000 head if you look at the non-strike weeks last year, and this year we're at about 8,900. So we're relatively flat, but certainly not up. And that's one of the things that we would have liked to have maybe seen. Our export of cattle for slaughter is down a little bit to the U.S. year to date, and our provincial slaughter is down about 7%. So again, that all goes to this idea of it's not so much a demand thing, it's a supply thing. That can create opportunity for producers in terms of marketing. Cargill and St. Helens are always looking for cattle, but there's some challenges obviously within that. And one of the things again that we've done, this is the same for the U.S., it's the same for Western Canada, is that we've addressed this smaller number of animals by producing a heavier animal. And the average weight has increased quite significantly both across Canada and in Ontario. Ontario numbers have tended to historically, from a carcass weight perspective, exceed that across Canada, and that will continue to hold true. I think one of the things to think about from a backgrounding perspective, and this will come through when I talk a bit about some of the numbers here, is that the ability for feedlots to have a consistent animal, a conditioned animal, one that they feel that they can get to that kind of weight, compared to if you were to go back in 2000, it's a different story. The animals need to be able to carry much heavier, and that has had a pretty big impact on genetics and selection and process in feedlots. And so as a backgrounder, I think that's one of the things to think about hard as far as if you're going to either retain your calves and background them or sell them, is where your calves fit in that, and whether or not they have the potential to sort of fit within that and be seen by feedlots as having that, because that plays pretty significantly into the demand. On the basis side of things, again, historically we're in an import situation when it comes to 5-weight cattle. So basically our calves that we're talking about here today, the ones you're thinking about retaining, etc. The dotted line here is your 5-year average, and again, it's been an interesting few years. But what we've seen the last 2 years is continued strength. So that the dark line being 2024, following similar seasonal trends, but quite a bit above. So in other words, again, a reflection of strong demand and limited supply. And then 2025, even higher than that, certainly in the midsummer, which again is not inconsistent because that's your grass period and it's harder to get those animals available. So again, that also plays into this idea of thinking about what it is to be selling calves, recognizing that most people tend to be selling calves in the spring or fall. And I'll look at some examples of that here in a minute. What we've seen in the last few weeks during this sort of run is, it's not uncommon for the basis to fall as volumes come through, et cetera. But we've seen a pretty big drop off of those highs. And that could be a function of a bunch of things. But again, I'll come back to that in a minute. But, normally speaking, our basis charts are on average, not on sort of the top end or low end of ranges on sales. And I'll come back to this, but the size of range on some of the sales lately, from my perspective, has been pretty wide. And without being there, that to me is an indication of, on the bottom end, some of the groups of cattle maybe haven't been as strong, and that in turn is driving some of those price changes. And that, I think, is a big issue if you're thinking about retaining or selling into the markets. On the 9-weight side, which is effectively that animal that would be coming out of the background situation, typically we're on an export basis, so we're below Chicago in that regard. And we've, for the last 2 years, for part of the year anyways, until we hit the fall run kind of thing, we've been a bit weaker than that average. And again, we've stayed below that average this year. Again, I think that's a function of that shortage. We're bringing more cattle from Western Canada, et cetera. But as you can see, it's dropped off quite a bit the last couple of weeks. Now, again, that is an interesting one because in reality, there's fewer people generally bidding on 9-weight cattle than there is on 5-weight cattle. And in generally speaking, it's a different sort of business model. And I'll go through that example, or I'll talk about what that means here in a minute. But that is something to keep an eye on if that basis continues to drop. It's a function of where people, feedlots in particular, see things going in the next number of weeks. Typically, again, you're on feed for 26 weeks from that 9 weight to the 15 or 1600 pounds. The other thing I'll mention is that if you look at the numbers for a lot of feedlots now, and this is, if you look at the RMP program, for example, the background category for steers goes from 550 to 900 pounds. That has historically been sort of the normal background range in that sort of weight category. But a lot of the feedlots in Ontario, if you look at the numbers, a lot of the cattle now are going into the 1,000 pounds. So that extra 100 pounds can change price differentials, but it can also change, the nature of feeding that animal a bit. So as somebody thinking about retaining calves and sort of moving to that background model, that's also something to think about in terms of where you might want to go with that. On the fed cattle side of things, again, we have two base prices that we use. We have the live weight slaughter price on the left, which again comes at auction, and we've seen a dip in the basis there, similar to these other categories in the last few weeks. And on the rail grade side things, which is again largely self-reporting through producers selling into Cargill or St. Helens, a similar dip, but the two follow each other fairly closely historically, anyways. And again, I think what this is a reflection of is basically that there's a little bit of uncertainty there from the packer point of view. There's some challenges in terms of the economy, and that might start to affect bids. I think, again, the only thing that really counters the shortage in the market as far as the number of cattle goes is sort of overall economic conditions, and that can play out in a variety of ways. But I think that bit of a dip there right now is a little bit of a reflection of that. But again, in terms of sort of the general longer term trend, the reality is that, for those of us that have worked in the industry for a number of years, we thought 2015 was a peak that we might never see again, and we've eclipsed it by a long shot. You never say never in an industry like this, but I think the reality is that there isn't a whole lot of things that would push things down too much. But on a day-to-day basis, from an auction perspective, which again is more the focus of tonight's presentation, there's some inherent risks in there that you have to really keep mindful of. But again, the general sort of market fundamentals would suggest that things will continue to sort of be pretty strong. And similarly, from the perspective of feed, as far as if you're buying feed, et cetera, if you're looking at sort of the opportunity cost of putting corn and meal, et cetera, through cattle, again, relatively flat prices, having come off some pretty big highs. And not a lot of potential, really, from my perspective, of major increases in prices. But again, this all comes back to sort of your ability to sort of be able to pre-buy, et cetera, if that's your business model. If you're growing your own, which a lot of people are from a corn silage point of view, that can be a self-insuring model as well. So in terms of looking at sort of the economics of background, again, this is a challenging industry. So again, to start off with, I think the key things to think about again would be, your capacity, your feed capacity, your feeding capacity, your experience doing it, your ability to have and maintain those animals and get that strong conditioning on them in terms of having an animal in, we're assuming here 900 pounds that's going to be in demand with feedlots. If you have an opportunity to have a direct contract with a feedlot, that can be a really strong thing. It comes with other risks as you're making a commitment on price at times, and you may lose some of the upside, you may protect some of the downside, but you need to know your costs and the ability to translate that into a decision to contract. So there's a lot of factors at play here. And so if you haven't done it a lot, this can be a really challenging thing. And so I've tried to look at a couple different twists to this. The numbers that are in here as far as the costs, et cetera, go largely derived from the backgrounding program and RMP. When I do the forecast with respect to the feedlot side of things, hogs, cow, calf, that kind of thing, we tend to use the RMP model as a way to project that. So that, I think, has been pretty successful here. So I've kind of went through two scenarios. One is a situation where the producer is backgrounding and planning to put steers on grass with a sale in November. And typically we would look at about not 1.9 pounds of gain per day. And we're estimating, if you look at the RMP numbers, about 61 cents a pound this year in terms of cost. That, generally speaking, is 184 days to get that 550-pound steer to 900 pounds. And that would cost you roughly $213 a head. If you go through some of the community pastures in Ontario, which is another option, some of the pastures are upwards around 90 cents a pound. So that's around $315 a head. I know that for a lot of people, 184 days is relatively long on pasture. I'm usually 150 to 160 days myself, but I've tried to do this to keep the numbers similar. So that's also something to think about. The other option is if you're planning to feed with a May sale, so you're looking at this time of year right now, recognizing that you're going to be putting these cattle on feed. The numbers coming out of RMP is we would have a typical gain of about 2.12 pounds a day, about 75 cents a pound on gain in terms of feed, which is about 42 pounds of feed a day, 40.3 pounds of corn silage, and about 0.16 pounds of concentrate. And so if you look at that cost structure over the last 15 years, it's been as low as 62 cents a pound on gain, and it's been as high as $1.01. So this is a pretty big one. And your ability to turn that feed, that 42 pounds, into 2.12 pounds is really tricky. And similarly with the pasture gains, right? It's not always easy to get 1.9. Sometimes you can beat it. I know from personal experience, and other times you don't. So those are some of the nuance in this industry that's a little bit trickier if you're not doing this regularly, or because of the nature of it's kind of a one-shot deal as opposed to a feedlot, which is moving cattle in a much more regular sequence. So the cost on the feed side, or if you're feeding the animals, is $263 a head. If you look at opportunity cost, in both cases, if you're retaining that animal, you've got about $30 in foregone interest that you would, if you had sold the animal, put the money in the bank at a relatively safe 2% GSE that's out there right now, you're out about $30 a head in terms of foregone interest costs. And so if you look at the backgrounding steer margin over the last number of years, I went back to pre-BSE for this example. And the reason is that, again, so this is the margin. You bought the steer, you fed the steer to 900 pounds, you've sold the steer, and that's how much money you have left to pay for your overhead, et cetera, on your farm, which for many farms is in the neighborhood of $100 a head, based on my experience. And so if you go from 1999 all the way through to about 2013, oftentimes it was negative or maybe $30 or $40, which means for a lot of producers, they weren't really in anything when you figured in that overhead. As you've continued through the last number of years, that has increased, and it's up to one of the highest levels right now. Now, again, there's other risks at play there, and I'll come back to that in a minute. And so looking forward, again, if you look at where corn prices on the spot are going, we're likely to see some seasonal peaks for both corn and soybeans through next summer when we tend to have shortages. That tends to be when the basis gets to the highest level. But for the most part, if you're looking at pricing and thinking forward, relatively stable prices from a corn perspective, and certainly opportunities to hedge or to pre-buy. On the feeder side of things, on 5-weight cattle and 9-weight cattle, again, we're at some pretty high levels right now, and the graph in terms of the units or the scale probably is a little bit misleading, but I wanted to be able to point out that we're talking about a 40-cent change here over the course of a year and a half on both sides of the equation, or even less on the 9-weight side. So in other words, that's a relatively flat model with some of the normal seasonal variation come in. So again, relatively stable from my perspective. Now, the challenge is that we're dealing with auctions. And so again, auctions are an important tool. They're important from a price discovery point of view, but they carry some risk with it. So I've got two examples here. I'm going to go through them relatively quickly, and James and then we'll have the presentation available to anybody who wants to go through the math. The links that I provided here are right from the Beef Farmers of Ontario, provide excellent resources to producers. And this is an example. If I was doing this last spring, so 2025, and I'm thinking about background in cattle on grass. So just went through an example of how you might look at the math here. So last spring, May 15th, I could have sold a 550-pound average steer. Now, average is a relative term. I'll come back to that in a minute. That would have brought around 608, 100 weight, which would have been about $3,200 roughly. Now, the range was 550 to 664. That's a big range. And so again, if you're paying on the high end, that's something really hard to think about. paying on the low end is also something hard to think about. And it's important if you're in this industry and you're thinking about considering, do I retain or move? It's important to know where you think you might fit in and track that. And I'll talk more about that in a minute. If I look at that same point in time, the close on 9-weight steers at Brussels at that point were between 442 and 480. So again, the 9-weight category, because of the nature of it, tends to have a smaller range generally. And so if you look at futures markets at that point, the May futures, which was the nearby, or were in the nearby, was 296 US, and the November CME, November Chicago, was 291. So they were suggesting about a 2% decrease, or negative carry, as we tend to call it. The Canadian dollar is relatively flat, and the basis for basically November is around, at that point, around 550 under. So in other words, we would, and that shouldn't say May, it should say November basis. But that's what basically saying is that normally come November, we would expect the basis for 9-weight cattle to be 550, 100 weight under the adjusted price. And so if you want to estimate what that price of that 9-weight steer might be at that point in time, the futures carry with the basis would get you around $399 100 weight, which is around $3,600 per head for that 9-weight steer, or 900-pound steer. So if you compare that again to that 3,200 that you might have received for that calf when it was 550 pounds, you're considering, well, your feed costs, your overhead, can you cover that? Now, again, this is on average to average. If you bought on the 664, which was the high end of the range, and then you come through and you haven't conditioned that animal, or that animal's out of condition, or you happen to hit a weak sale, there's a lot of different things that can happen if you bought from auctions. That can be a major risk if you then end up on the low end of the range on the day you sell your 9-weight steer coming out, and that can eat up almost all of that opportunity. And so that's one of the challenges. And again, that's not something you can really hedge in the futures market if that's something you want to do in that regard. So again, that's something to think about. And that's an example from a spring perspective, recognizing that the grass gains, if you could get that amount of gain, is in the neighborhood of $200. If you look at the fall example, the way we are right now, again, same link to the BFO. On November 13th, you could have received around 574 for that 5-weight animal. That's around the $3,200. And again, you're talking in the neighborhood of a range of 510 to 656, a pretty big range. Again, the 9-weight animal on the close at Brussels at this point in time was 450 to 486, and there's about a 9% decrease in carry through to May next year. Canadian dollar relatively flat, and the basis to May is $18 per 100 weight under, so negative. And so basically, if you're looking at sort of the futures market and looking at what that might mean, that would work out to in the neighborhood of $3,700 for that animal at 900 pounds in May. Again, comparing that back to that earlier purchase price or sale price that you were foregoing to bring that animal into the feeding system. Again, you've got in the neighborhood of $250 to $300 in feed costs, assuming you can meet those averages, and then whatever your overhead is. So, the math there is reasonably tight depending on where you end up. And again, if you bought at 656, your revenue, is quite different. So again, it's one of those things of where the model sort of sits in and where you might be in a position to play that out. If you look at then to wrap up where the feeding margin might look like over the next year, again, like the feedlot margin, one of the things that we're seeing is that as we go through the next year, a lot of the cattle coming into the feeding system, again, recognizing it's 26 weeks, and with this group, you're talking 5 to 6 months. The in weights is relatively large. So if you're somebody who's bringing in those calves, right now, what we're seeing is over the next year, again, this is on a weekly basis, but the margins are declining. And the reason they're declining is that we're hitting some pretty high prices on those in weight calves that are then feeding through the system as the year goes on. That is despite the fact that we've got relatively stable feed costs. There's not major changes. I think 75 cents a pound on gain for backgrounding is probably here to stay for the next year, within pretty tight range on that. And again, you're only talking not a huge drop in terms of the value of that backgrounded animal. So it really hinges on what that in price is, and in this example again, what you might forego if you're choosing to retain or move forward. So again, I think one of the last things to think about is how you manage expectations and protect yourself in this regard. So number one, these are auctions. And that means that last week's price won't necessarily be this week's price. And that is a lot different than if you're somebody selling corn or soybeans or even wheat, where we're dealing with the board price. And yeah, the board price moves, but it's not the same as auction prices. And that's why there isn't ranges on the board prices for crops, and there is in terms of auction. So that's important. Number two is, again, know your cost of production. So understand that, track it over time. Again, whether you're on grass or you're feeding, whatever your model is, understand that, and in particular, try as best you can to figure out how that cost can relate to gain. Record your market prices received or paid, and understand the attributes of those cattle. So if you're always buying different groups of cattle, that can be a real challenging thing, not only in terms of feeding them out and getting performance numbers, but also in terms of understanding what you might get in the market and how that might change. If you're selling at a specific auction, so if you're always going to Horde Station, or if you're always going to Cookstown, for example, look at the weights, look at the frame categories that you're being grouped in. It's not always a fun thing to go watch your cattle be sold, but it can be telling in terms of understanding the intensity of bidding on them, understanding who's in the room when that's happening. That kind of thing can be pretty telling, especially if you're doing this all the time. Where you fit in that range is important. What the volume is, if it's a low volume day, a high volume day, the same as if you're selling at a special catalog sale, like that kind of thing. And then if you don't sell at a specific auction, looking at somewhere close to your area, trying to understand that and use it as a reference price. And then also, if you want, looking at the futures market, we publish that data as the ministry, and so does the BFO, in a little bit different form. Ours is more in data tables. Theirs is in weekly or daily reports. So again, I think that there isn't necessarily, to wrap up, there isn't necessarily a definitive answer in terms of retain or sell. It's pretty standard messaging in a lot of respects from my perspective. Know your numbers, understand your financing situation. We're seeing a lot more people with the feeder finance program for that reason. And be in a position where you feel you can control the things you can control. And the more you have the ability to do that, I think the better position you'll be in. But again, making that calculation, I think for a lot of people right now, if you haven't been backgrounding regularly, retaining calves is a much riskier environment, not because of where prices are going, but because of the costs and the situation facing you as a producer, and your ability to control that efficiently, given it's a kind of an absolute thing in that regard, right? Once you're in it until the sale period. So I'm going to stop there, and we'll answer a few questions.